the audit manager on the Alliances audit. So that is why I'm here. I'd also like to introduce Brendan Healy, who is in charge of our tax department, and he's the real expert. And a little background on the firm. We are the largest independent accounting and consulting firm in the Northeast, New England. We do about 350 not-for-profits. So this was really our bread and butter. So we're very happy to be here and to give you a little more information about the employee retention tax credit. So with that, I'm going to hand it over to Brendan, and he's going to help educate us all.
Well, thank you, Tom. And thank you, everyone, for your time. Thanks for joining us on this. This program, the Employee Retention Credit Program. It's a very powerful program if you qualify. The numbers add up very quickly, and it's a powerful tool for nonprofits, also for profits, but we're talking about the not-for-profit industry for today. So to dispel one of the myths you can that some folks are confused about, nonprofits can claim this credit, and we'll talk about that. And we'll go into more detail as we go on with this session. So this is an informal session. Ask us questions if something's not clear. Please raise your hand or put a question in the chat. Stop me if I'm going too fast or if something's not clear. And then certainly afterwards we can talk more as well. So however we can help. So getting started and kind of reviewing the agenda, we're going to talk about this credit, the Employee Retention Tax Credit, ERC. What it is, how we could be eligible for it, and just some of the different rules around that. And I will tell you, there's a lot of misinformation out there. There's a lot of confusion. I'll go into the history a little bit, but there's been a number of changes to this program. The program's been around for a while, many years, about 20 years, but this version of the credit over the last couple of years, starting in 2020 and into 21, as a result of the pandemic, even within that short amount of time, there've been multiple changes, legal changes to this credit, and so there's a lot of misunderstanding around it. So we want to hopefully clarify some of that for you guys. So let's just jump into it. What is this thing? Why are we all here? To put on our nonprofit hat for a second. And most nonprofits generally don't pay tax. How do we get a tax credit? Well, it's a payroll tax credit. So essentially, when all is said and done, if you qualify for the credit, you're basically going to ask for the IRS to give you back the employer portion, either the Social Security or the Medicare, depending on the quarter, but you're asking for the payroll tax credit, the payroll taxes you paid, you're asking for those back. And then on top of that, because this is what they call a refundable credit, it means the IRS gives you more money than you paid in back. So as a very rough example, if I paid $50,000 in employee payroll taxes on behalf of my employees, but my credit is $100,000 under the calculations, the IRS will give me my $50,000 back plus another 50. So my refund from the IRS would be $100,000 in my example. So again, it's a lucrative credit, and although we're not paying income taxes, that's okay because we're getting not only payroll taxes we paid in back, but we're getting more on top of that. Hence the term refundable credit. So the history of the credit. So as I mentioned, the credit has been around for a long time, the employee retention credit, and it first came into fruition, I believe, 20 years ago with Hurricane Katrina, when New Orleans was flooded, and that was a disaster. So since then, they've implemented the credit throughout the years generally for areas that have been hit by a natural disaster. So if a hurricane went through Florida, they would allow the businesses in that area to take advantage of the credit. So fast forward to 2020, really March of 2020 under the CARES Act. And due to the pandemic, they reintroduced the credit to us, to employers. But unfortunately, back then, on the initial reintroduction of the credit, so to speak, in March of 2020, you could only go for a PPP loan or this credit. You could not do both. You could only either or. And so most folks were focused on the PPP stuff and maybe didn't pay attention to the employee retention credit as much. But then several months later, there were law changes, and then even months later after that, there were changes. And so Congress said, no, we're just kidding. Even if you went for PPP, you could also go after this credit. And by the way, not only is it good for 2020, but we're going to expand it initially for the first 2 quarters of 2021. Then they expanded it to all 4 quarters of 2021. And then they took away the 4th quarter of 2021. So lots of changes over a relatively short amount of time. But as we sit here today, what we are allowed to do, if you haven't claimed the credit and you want to claim the credit, we are allowed to look at it for essentially March 13th, which is kind of when the pandemic hit and we reacted to it. So March 13th through December 31st of 2020 is the 2020 credit. And there's a little difference in the credits. And then you potentially could qualify for Q1, Q2, and Q3 of 2021 for the credit, but generally not Q4 because Congress eliminated it. And they eliminated it this past fall. They canceled the credit for the 4th quarter. There is talk about reintroducing the credit for the 4th quarter of 2021, but we have not, that to my knowledge, that has not progressed through Congress the way we would like it to. And so but as we sit here today, that is not the law. That's just, they're just talking about changing the law. So this 1, 2, 3, 4th bullet point, essentially, and we'll go into more detail, okay, that's great, Brendan. The credit sounds wonderful. How do I get it? Well, you generally have to qualify under 2 ways, and it's an either or test. So you don't have to do both, but it's either or. And this is some more confusion because the first one is a significant decline in gross receipts, where for 2020, you have to be down about 50% or more in gross receipts. Or in 2021, you have to be down at least 20% or more in gross receipts. And I'll go in a little more detail what that means, et cetera. But that's one test. Then put a period and then jump into the second test. They're not related. They're 2 separate tests, and it's an either or test. So even if my revenues weren't down, okay, put that to the side. I can do this other test, which is what they call a full or partial shutdown test due to a governmental order. Now, the full shutdown is maybe a little easier to conceptualize. Let's just say, if I was a restaurant, the government said, restaurants, you have to shut down. That's kind of easy. If we were a movie theater, they said, you have to shut down. You can't be open during the pandemic. So in certain circumstances, a business was told they had to shut down. They had to close their doors for a period of time. Those businesses would automatically qualify. No, not a lot of thought involved, and they could go after this credit. But the work and the putting on our thinking cap, so to speak, occurs under what they call the partial shutdown rules, and it's kind of a misnomer. You don't necessarily have to be shut down, but you had to have been affected in a significant way by a governmental order as it relates to COVID. And we'll get into more of that discussion on later on the slides, but that's really where you should focus your time. If you don't meet the gross receipts test, and if you don't meet the full shutdown rule, or if you were never fully shut down by the government, you should really think about this partial shutdown, what it means, and how you might be able to qualify for the credit. And then the last thing on this slide I do want to point out is a although, this version of the credit, as I said, is, call it 2 years old, and the federal government can't do very much in 2 years, let alone issue regulations and detailed guidance and things like that. So there is some guidance. The IRS has published some guidance, and we've got some examples of that in these slides. But I will say there's a lot of questions still remaining that the IRS hasn't answered for us. And certainly Congress passed the law and handed us the law. That's great. And the IRS has to essentially administer that law and enforce that law. But we're hoping that the IRS would kind of give us more parameters, more rules, more guardrails to keep us in the lane, so to speak. But that really hasn't happened. So again, there is some guidance, but it's not a ton of guidance. So some of the questions you may not have answers because no one has really given us an answer on it. So I'll leave it at that. So let me jump into kind of the basics of the credit. So and keep in mind there's a 2020 credit and a 2021 credit. And although they're similar, they're different. And as I'm talking about these credits, I'm talking on a calendar year end. So Q1, Q2, Q3, so to speak, are calendar year quarters. So this credit kind of follows the payroll cycle. Many of us on this call are probably on fiscal year ends. That's irrelevant in some respects because we're just focused on calendar year end payroll stuff. So for 2020, the credit is up to 50% of what they call qualified wages. So qualified wages is generally what I pay an employee, and on top of that, the cost of the health insurance, the employee costs, which should be in their wages, maybe not taxable, but it still should be in their wages. So the employee piece and the company piece. So it's wages plus health insurance costs. Those are the dollars we're allowed to calculate this credit on. And so for 2020, it's a maximum of $10,000 of wages per employee per year. So it's for the year. So if I have someone making $20,000 a year, they're making so $20,000 in my example is $5,000 a quarter. So they might, in order to maximize their credit, you might have to take their wages for 2 quarters in 2020 to get to that 10,000 max of wages times 50% is a $5,000 credit. So even though you might do the calculations on a quarterly basis, every employee is capped at the $10,000 of wages times 50% or $5,000 credit for the entire year of 2020. So fast forward to 21, if we could jump to the next slide. The 21 credit looks at it on a quarterly basis. So it's up to the answer is $7,000 per employee per quarter, because they look at up to $10,000 of wages per employee per quarter times 70% is the $7,000. And if I qualified for 3 calendar year quarters in 21, I get to the generally the maximum of $21,000 for 2021. And again, as a reminder, Congress generally eliminated that the Q4 credit for us. There are some limited instances where if it's a startup business, you might be able to claim it for that, but I don't want to get into that on this call per se.
So Brendan, that's how we come up with the 26,000 maximum per employee, the 5,000 in 2020, and then 7,000 for 3 quarters in 2021.
Yep, that's a very good point. Right. So if you hear $26,000 is 5,000 from 2020, 21 from 21. Good point.
All right, Brendan, I'm going to jump in. Tracy, did you have a question? No? Okay, then I have a question that came into my inbox, and it asks, so if an organization didn't lose 20,000 in the 3rd quarter, it was lower, they're not eligible?
So remember, it's an either or test. So there's a there's the revenue test. And so they may not qualify under the revenue test, but they might qualify under the partial shutdown rules test. So it's either or. So either I had a decline in revenue or I was fully shut down or partially shut down. So to answer the question that I think was asked, just because the revenue wasn't down enough, let's say you're down 18%, that's not enough. You wouldn't qualify under that way. You might qualify though under the partial shutdown.
Thank you.
Yep.
And we've got a question in the chat also from
Okay.
Sandra. If an organization is also a state/government registered entity, are they eligible to receive the credit?
No, unfortunately, no. That's a very good question, but governmental entities are not allowed to claim the credit, unfortunately. Even quasi governmental agencies cannot qualify, unfortunately.
It looks like we have another question. This is a good one.
That is a good one.
Are you still eligible if you had the partial shutdown, if you actually had a higher profit?
Yes, and thank you. I didn't see who asked that question, but thank you for asking that question. And this is one of the big misunderstandings. Yes, you could have had a better 2020 than you did. That could have been the best year. 2021 could have been the best year you've ever had. And yes, you still may qualify for this credit. So that's why you really got to look at this. Again, there's a revenue test that says, hey, am I down revenue? That's one test. But if I don't meet that, put it aside, ignore it, and focus on the partial shutdown rules or the full shutdown rules, but mostly the partial shutdown rules, because it is very, very common that an employer might be the same as they were in 19 or 18, and maybe the pandemic hurt them a little bit, but they came back, or hurt them a lot, but they came back strong. So they're flat or they're up a little. That's okay. You don't necessarily have to be down to take the credit. You could have had the greatest year in your history and you could still qualify for this credit. So that's a great point to drive home. You really got to look at this for your organization.
Yeah, this is also a
This
great
is a great question.
I think Brendan, you might be getting this into maybe a few future slides. But what do you do if you have a lot of grant funded programs, or if you got PPP 1 or 2?
Yep. So I'll just address it now since we've asked the question. So and many people did get PP1 and or PPP2, you can still qualify for the credit. You can still claim the credit. You just cannot use the same wages for PPP forgiveness and the credit. So as we're talking through these examples, we're talking about a maximum of $10,000 of wages for 2020 times 50% is the $5,000 credit, or 10,000 of wages per quarter in 2021. So those, if we're going to take the credit, those $10,000 of wages cannot be used for PPP forgiveness. But in my experience, there's generally plenty of PPP wages for forgiveness and residual wages for this credit. So to answer your question on the PPP, you can't use the same wage dollar for forgiveness and the credit. However, you can use just enough wages for PPP forgiveness and then the remaining wages for the credit, or vice versa.
And that also extends to the federal or state funding as well. You can't double dip.
You can't. So I want to be careful about this. So yes, you can't. I didn't want to say that. There. So remember how I said there's limited guidance out there with these credits. So I will say the answer is it is not clear. It is not crystal clear how you treat federal or state grants. We have heard verbally from representatives from the federal government that they don't want to see double dipping. So for instance, if I'm getting federal grant money and it's a payroll cost reimbursement grant, maybe I'd stay away from those wages for the credit. But the fact that I'm getting a federal or state grant in and of itself, I don't think, my opinion, I don't think precludes you from claiming it. I would encourage you to consider it. But again, I will tell you, it's not crystal clear. And we were hoping for some clarification, but it just hasn't been out there. But very good questions. Okay, so
On to the next one.
yeah, let's move on to the next. And then Stephanie, another good question. Let me go through the slide and then we'll get to Stephanie's question. So for 2021, they clarified and expanded and opened up the ERC to many different types of entities. They clarified that nonprofits can take it. Churches, public schools, private schools can take it. So it's a very broad credit. I'll leave it at that. So again, from the 2020 to the 21 credit changes, they bumped the 50% to a 70%. So it becomes, instead of $5,000 per employee, it's a $7,000 per employee maximum credit. And in 2021, the fourth bullet point there, the decline in gross receipts doesn't have to be as big. So let's talk about the gross receipts test really quick. So originally the rule said you look at 2019, and 2019 is kind of the base. That was a pre-COVID year. You look at 2019 on a calendar year basis, look at quarterly revenue from 2019, then compare it to quarterly revenue in 2020. And if I have a decline, is it 50% or more decline in gross revenue, in revenues? And I will say 50% or more is a big threshold to hit. We've had a lot of businesses, a lot of nonprofits that have suffered during the pandemic, but not a lot of them have hit that 50% or more threshold. Some have, but it's fewer than you would think. But if in any quarter you're down 50% or more in revenue, you qualify for that quarter. And there's a little secret. Once you qualify for one quarter, you automatically qualify for the following quarter. So that's something some folks are missing. And so I'll say it again. Once under the gross receipts test, remember there's two tests. So under the gross receipts test, if I'm down 50% or more for 2020, and then in 2021, it drops to a 20% test. But if I meet that threshold under the gross receipts test, I qualify for that quarter. So I look at the wages paid in that quarter. But I also magically, because of the way the law is written, I magically qualify for the following quarter, whether my revenues are up or down, or it doesn't matter. I qualify for the next quarter automatically when the previous quarter, I meet the test under the 50% revenue decline or 20% revenue decline in 21. So if someone's taking notes, write that one down. You automatically qualify for the following quarter. Okay. And then, there's another test for 2020 versus 2021, and it's the large employer test. So if in 2020, I'm less than 100 employees, I'm considered a small employer. If I have 100 or more, I'm a large employer. And that comes into play because the wages that qualify for the credit for the large employer are generally only the wages that you paid people not to work. So I just want to talk about that for a second. So if I have 150 employees and I think I'm going to qualify for this credit, that's great. Maybe I do qualify for the credit, either under the decline in gross receipts or the full or partial shutdown test, either or test. So yay, Brendan, I qualify for the credit. I want to go for the credit. But there's another step involved, and that is you can only count in that $10,000 wage bucket $10,000 of wages times 50% is a $5,000 credit. In that $10,000 wage bucket, I can only include wages that I paid people not to work. So if, let's say, I sent people home during the pandemic because it was, well, the world was falling apart, and I said, we'll keep paying you, just go home and, stand by. Those wages count. If my team members came into the office or the building but didn't have much to do, but I kept paying them, and I essentially paid them not to work, that likely would qualify as well. And you can kind of expand on that. If we put our thinking caps on, we can think of some other issues. But at the end of the day, if I'm a large employer, I can only count the wages that I paid people not to work. And thank you, Suzanne. Good question. So for 2020, the threshold is 100 employees. For 2021, the threshold is 500 employees or more. So it was much easier to hit that threshold, I'll say, in 2020, but when they expanded it, they wanted more folks to qualify easier. So they increased it. So for 2020, it's 100 employees. For 2021, it's 500 employees.
Hey, Brendan, real quick, is that W-2s or is that full-time equivalents? Or is
That's a
there
good-
not good guidance at this point?
No. There actually is. So it's generally, and there's some nuances, but generally it's anyone that's worked 30 or more hours a week is a full-time employee for purposes of that 100 or 500 test. And again, 100 is for the 2020 year, 500 is for the 2021 year. Now, I get the question all the time, oh, hey, I don't qualify for this because I had 200 employees in 2020. That's okay. You still could qualify. You just have to do additional work in documenting and quantifying how you paid someone not to work. So the fact that I'm over those thresholds, let's say I have 200 employees, and let's say I magically grew to 600 employees in 2021, I'm above those thresholds. That's okay. I can still qualify for the credit. There's just more work involved to get there. That's all. So the goal line is farther down the field than it was if I was underneath those thresholds. Mm-hmm. So if someone says, nah, you're over 100, you don't qualify. Sorry, that's not true. You still may not qualify, but you gotta think it through. The number of employees does not disqualify you. It's just whether or not I have to do more work in analyzing what they did or what I paid them not to do. That's all. So there's certainly some confusion there.
It would now be a good time to circle back to Stephanie's question.
Yeah,
Government
that's great.
Funding. Yep. So is that more an issue with the state funding agencies and whether or not you could use that as an expense for your single audit, or and that the IRS is going to care?
So the quick answers is I don't know the answer. I don't. There is no answer, and I know that's a cop out. I don't mean it to be. What we've been doing is we've been, as the accountants, we've been anonymously calling state agencies and asking their advice and asking their opinion. And I will tell you, a lot of agencies and folks we talk about aren't really aware of this, haven't really thought about this, haven't really considered it. So unfortunately or fortunately, however you look at it, we're kind of educating the agency personnel we're talking to at the same time we're asking them for an answer on a very important question. So there is no answer. There's no official answer. But if you're extremely conservative, then maybe you stay away from it. But Brendan Healy, the tax guy, is willing to take a little bit of a risk within reason, and I would argue that maybe state dollars could qualify, or state grants or state reimbursements, et cetera, because it's a federal payroll tax credit. I'm not saying that's the answer, but I'm saying I'm willing to have that discussion with a client.
It might also be worth it to have the conversation with the auditors as well to make sure they're on the same page. Here's another good one, Brendan. Going back to that gross receipts test, is it just one program or is it across the entire organization?
It's the entire, that's a very good question. It's the entire organization. And if there were related organizations, which I don't, if we owned another organization, let's say, there you may have an aggregation test. So it's possibly so if you own another organization, you may have to aggregate the numbers for the gross receipt test. But to answer the question, it's an organizational test, not just a specific program test.
And Brendan, is that on the cash basis or the accrual basis?
It's on the accounting method you use for your 990 for your tax filing. So, yep. Very good questions. Okay, so any other questions before you keep moving?
I think we had just one more similar. What do we do with COVID relief payments?
Yeah, that's a good
I think that was
question.
probably the same answer.
I believe you would include that in your gross receipts test. So if you got a COVID relief payment, generally you should use that for that test. If it was a relief payment specific to payroll, and maybe it was, but I think a lot of it came through the state, but if it's federal money specific to payroll, then maybe you stay away from that. So again, there is no specific answer. You'd have to look at kind of a facts and circumstance discussion. Oh, wait, I saw a couple of questions come in, Tom.
Yeah, for the sake of time, it may be easier to continue with the presentation.
All right, I'll
To
just
the
keep
rest of the
going.
questions
I'll
at
keep
the
going.
end. We're already at 1:35.
All right, I'm gonna keep going. Yeah, so I think we covered the slide. So again, it's an either or test. Either I had the decline in gross receipts, which was a 50% decline as compared to the similar quarter in 2019 for 2020. And then in 2021, which you'll see, you still use the 2019 quarters and compare them to 2021. So it's still 2019 as the base. You compare it to 21. And then if you're 20% or more in 21, you meet that test. But let's keep going, Tom. Yep. And yep, I'd keep going. Next slide.
I think we might have discussed this one as well.
Yep, I think so. So again, it's just to drive home the point. I don't mean to beat it to death, but I will. It's either or. So if either I meet the test for the decline in gross receipts for 2020, which is the 50% drop, or 2021 is the 20% drop, either I meet that test, or if I don't, then I look at the full or partial shutdown test. But I don't have to hit both. Okay, so here's where we kind of get into the nitty gritty, or the gray area, I like to call it, or the really the thought provoking stuff. So under the full or partial shutdown. So again, there's two tests. There's the revenue test. Put that aside. We're done talking about that for now. Now we're talking about the full or partial shutdown test. So what the law says is, it says if we're subject to a governmental order that limited our ability to engage in commerce, travel, or group meetings, then we would qualify under either the full or partial shutdown. So again, that's kind of a broad statement and subject to interpretation. But that's what the law says. So I'm sitting in Hartford, Connecticut. So I'm under the jurisdiction, and a lot of us are under the jurisdiction of the governor of the state of Connecticut. And if you may recall, the governor was issuing executive orders, I wouldn't say daily, but it was almost daily, certainly during the beginning of the pandemic and during the height of the pandemic. So not only are various agencies issuing rules to us, or what they call governmental orders. But the Connecticut governor and the Massachusetts governor and lots of other governors were issuing executive orders limiting commerce, travel, group meetings, et cetera. So you really need to think hard. If you haven't qualified or contemplated this credit, you need to think hard about that, because whether you realize it or not, we were subject to a number of governmental orders. So anyway, so the law says we have to be subject to an order that limits commerce, travel, or group meetings. And that could be both a federal, state, or local order, but it just had to have affected our business. So the IRS in their limited guidance gave some examples, and we'll get to a few examples here and we could power through them if we need to. But sometimes a business has both an essential business component of it, or I should say a nonprofit. Sometimes a nonprofit has an essential, sometimes a nonprofit was deemed essential. And there's a lot of nonprofits that were. Sometimes a nonprofit might not have been an essential business, or sometimes there's both essential and non-essential components of the nonprofit. And so the IRS says, even though maybe some of the business or nonprofit was not essential, but some was, you can essentially look to either one of those to determine if you could qualify for the credit. So next slide. Another issue, and this is straight from the examples on the limited guidance from the IRS. Another example is, and you may have heard the term supply chain issues. Oh, we had a supply chain issue. Well, there's today, as we sit here today, there's still supply chain issues out there with businesses and nonprofits struggling to get products and goods that they need. But during the COVID pandemic, if due to a governmental order, there was a disruption in the supply chain for your operations, you can use that as well to qualify for the credit. So I'll leave it at that. So if you experience a supply chain issue where you couldn't get materials or products or things from where you normally would be able to, and you can connect it to a governmental order, then you could qualify for the credit. So the IRS gives an example of an auto parts manufacturing company, and essentially the IRS says, that manufacturer couldn't get its supply in the door because of another governmental order that stopped or disrupted its main supplier. And under those circumstances, that business would qualify for this credit due to that supply chain issue. The next one. Actually, if you go one more slide, Tom, I want to get into so if a business or a nonprofit has different components of it, and some of those business operations or programs maybe kept on chugging along, kept doing their thing, kept working like they always did, but some other pieces of the nonprofit or other programs had to stop or needed to stop. So that in my example, let's say half of the nonprofit continues as it always did, and the other half is shut down. Well, because of that partial disruption, and we'd have to look at it, but generally the nonprofit would qualify for this credit as well. So the IRS uses an example of a restaurant that has both sit down and takeout. And certainly at the height of the pandemic, restaurants were shut down. That's a no-brainer. They would qualify under the full shutdown. But as they started to open up again, sometimes restaurants, at least in Connecticut, were allowed to do takeout, still not indoor dining, but just takeout. Well, essentially the IRS says, well, a part of that business is open and running, but another part of that business is shut down. So their operations are not where they used to be. Therefore, they would qualify under the partial shutdown. And then take it even further in the IRS example, I think on the next slide, the IRS says, well, in this restaurant example, okay, they're open for takeout and they're doing the takeout, and they've opened up outdoor dining, but still not sit down dining. Well, they still qualify. But then let's take it even further in our example. The restaurant opens up again so that takeout's humming along and outdoor dining is humming along. And then now we go to the indoor dining. We're going to open that up, except you can't have as many tables in there that you normally did because of social distancing. You've got to spread everybody out and such that it's having what they call more than a nominal effect on the business. And therefore, under that general example, they would qualify still. They would qualify for the credit under the partial shutdown rules. So I put this in the slides, or we put this in the slides, really to drive home the point that, we might, read the letter of the law and say, oh, gee, we don't qualify. Oh, gee, our revenues weren't down. Or no, I didn't have a partial shutdown or a full. Oh, no, I don't qualify. You got to really dig into it, think about it, and look at it, because there's different ways to get to the result that you may want to get to. So,
Hey, Brendan, would a school be a good analogy that maybe before you had in-person teaching and then you had to transition to online, or if you're providing some sort of mental health clinician work and you went from in-person visits to telehealth and then back and forth? Could you draw parallels to this?
So the full answer is yes, those examples could be good candidates for the credit, but it's not a simple answer. So the fact that a mental health clinic went to online services or telehealth, that in and of itself is probably not going to meet the threshold. But there's other stuff involved in that, and there may be other ways that in your example, Tom, that could get to qualification for the credit. Schools, depending on what the school's doing and how it's servicing its students, very well could qualify for the credit. So there's different ways. You just got to look at it. You got to dig into it. You got to look at it. You got to talk to your accounting team. But there's different ways to get to the qualification for this credit. I think this is still the restaurant example. Let's keep going. So real quick. So an employer that reduces its operating hours because of a governmental order is considered to have partially suspended operations. And I think the next slide is an example of a food processing facility. So in this example, they normally operate 24 hours a day, but because of the COVID rules or OSHA or some other Department of Health, they have to shut down for a bunch of hours. I think 5 hours in this example. They have to shut down for 5 hours and clean and disinfect. So therefore, they're deemed to have a partial shutdown under the IRS example. So again, we put this in as another example of maybe the food processing facility is having the greatest year they've ever had, and yes, they were never told they had to shut down by the government. Okay, so maybe you think, gee, they don't qualify, but as you dig into it and look at their operations, oh, wait a minute, they have to stop production for 5 hours a day to clean. Well, gee, that's deemed to be a partial shutdown by the IRS, therefore would qualify for the credit. So again, just driving home the point that you really got to look at it different ways, and you got to look at it carefully. Multiple locations. So essentially, and I use the example, the state of Connecticut, let's say we had an operation in the state of Connecticut, and we also have an operation, and I'm picking on I'll pick on a state, but I'll say South Dakota. So the governor of Connecticut, I believe, well, because I live here, I know, was very very proactive with issuing executive orders, and the agencies were on top of this COVID crisis, and we were subject to a lot of different COVID rules, whether we knew it or not. We were subject to them. But maybe, and I'm not knocking the state of South Dakota, but maybe the governor of South Dakota was less proactive with the rules that Connecticut, and maybe, I don't know, but maybe South Dakota was less demanding and had less rules around the COVID pandemic. If we had operations in both Connecticut and South Dakota, we would still be able to qualify for this credit because presumably we were affected by all the rules that the Connecticut governor and the Connecticut state agencies implemented upon our operations in those rules, even though maybe the state of South Dakota, there weren't as many rules, but that's okay because of one jurisdiction, we're allowed to qualify for the credit for the whole organization.
Hey, Brendan, Dave's got a good question here. His organization offers janitorial services. Some of those locations were closed due to government order. Would that be a clear qualification for the partial shutdown?
So no, nothing's
No? Okay.
clear. However, I would argue that I would think that you would qualify for it because if you have a contract and you are consistently going to that location, and due to a governmental order, that location was shut down, I would argue that you may likely have a supply chain issue, and therefore couldn't operate like you normally did. So I would definitely look at that. Yep.
Sounds good.
All right. So, okay, really quick, I'll get into this because we're coming up on an hour. So the more than a nominal effect. So we talked about some examples of the restaurant operating and having takeout, but not allowing dining. In the example of the food processing company, working 24 hours, but now, shutting down for 5 hours. And there's lots of other examples. I shouldn't say that. There are some other examples out there, but essentially, in order to have been affected by the COVID pandemic for purposes of these credits, the thing in your operations or your business or your organization that was affected by the COVID orders has to be more than nominal within your organization. So I can't, I'll make an extreme example and maybe say I'm a restaurant, but I don't know. I guess an extreme example would be, I'm a restaurant, but I also do online. I sell pens online, but this is only 1% of my revenue because I just got this started, and my restaurant's operating like crazy now, but my online pen sales are very small. Let's pretend, for my example, that the online pen sales were affected by a governmental order, and I couldn't do it like I normally could because of COVID. Well, the question is that more than nominal as compared to my entire business? So do I have a program, a specific program within my organization that is more than nominal, so that one program that's affected by COVID, maybe the rest of the programs weren't, but maybe this one was, that has to be more than nominal as it looks at my entire organization. So again, I could have my total organization, but one program affected by this COVID stuff. As long as it's more than nominal, I would qualify for the credits. And the more than nominal test is generally 10% of revenue, or the employees in that program, 10% of the hours worked as compared to the whole organization. So what does that all mean? Essentially, as I'm looking at these facts, as I'm digging into this, if I only find a small piece of my organization that was really affected by a governmental order and for the partial shutdown rules, I've got to then take it a little further and say, okay, was this at least 10% of my revenue, or 10% of my hours worked? If so, then even though the rest of my organization wasn't affected, but this one piece was, okay, and it was more than 10%. Okay, now my whole organization qualifies and I can take the credit. So, Tom, maybe we bounce through. This is back to the 50% test, and this is the kind of the secret, the in the middle, right in the middle of the slide. This is how, as I said before, if you qualify under the gross receipts reduction test in one quarter, you automatically get it for the following quarter. Just remember, if you remember nothing else, remember that from this discussion. It's a nice way to get additional credits. I'm going to go to the next slide.
Maybe we skip over this one.
Yeah, let's hop over. Yeah, we're going to provide the slides to everyone. Yeah, we're getting towards the end anyways. I think we talked about this. The qualified wages have to have been paid during the period we're talking about. So after March 12th. So March 13 of 2020 through December 31st of 2020 is the wages and health insurance for the 2020 credit. And then January 1 through September 30th of 21 are the 3 quarters of the 21 credit. So yeah, so we talked about this PPP. If you got a PPP loan, yes, you can get the credit. There's some confusion over that. Well, the law originally said no, but then they changed the law. So yep, you can get it. You just can't use the same wage dollar for forgiveness and the credit, but most of the time it's not an issue because of the way. So how do I claim the credit? If we got in our time machine and went back in time, there were 2 ways to claim the credit, where you could either claim the credit on your timely filed payroll tax return. But my time machine doesn't work. So the only way we can do it now is by filing a 941X, which is an amended payroll tax form. And they're not that hard to complete. But that's how you claim it. So we, as an employer, you're filing quarterly forms 941 with the IRS, reporting and paying taxes as needed, payroll taxes. You file an amended form. It's called the 941X, and that's where you calculate and ask for you ask for the dollars back.
And I think this goes right perfectly into the question that just popped up. Going back to if you do amend 2020, this is a refundable credit, correct? So you're going to get a check back.
You will get back more than you paid in. Yeah, it's a refundable credit. So if you calculate, you will get a check back from the IRS, and you'll get back more than you paid in. But so
it's not offsetting your future tax liability.
Not anymore.
It's actual check.
It's a check. You're gonna get a check. Yep. And the checks are now taken 6 to 9 months because the IRS is so slow with their processing and everything. They're super slow. So you gotta wait. So I would encourage you to file sooner rather than later if you do qualify, just to start that waiting process. And
is there a deadline as well?
Thank you. That's another great. So is there a deadline? Yes and no. So yes, there's a deadline. The deadline generally is 3 years after you filed the payroll return, or I should say 36 months after you filed the payroll return. Is there an immediate deadline? No, because the earliest deadline would be really the tail end of Q1 of 2020, which, 21, 22, 23. So really March of 2023, or I should say April of 2023. So a year from now is really the first deadline. But so technically, yes, there is a deadline. It's 36 months or 3 years after the filing of the payroll form. That's really the deadline. There's no immediate deadline because you have another year to do this. However, I would say to file it as soon as you can, because the IRS they're so understaffed. It's just taking a long time for them to process these.
All right.
Is there a specific?
Going over, the 941X, the quarterly payroll tax return.
You got it. You use the 941X to ask for the money back. you got to calculate it. You kind of calculate it off to the side, and you got to run through your qualification stuff. But once you have the number, you use the 941X to ask for the money back. That's the form to use. And then lastly, and then we'll do some more questions if we need to. Some people have said, "Gee, why should I do this?" Well, we're kind of, we're all in this to help to support the mission, to help our constituents. So it's a program that's out there. So I would encourage you to look seriously at this. And if nothing else, it'll give you more resources to help the folks that you're out there to help. So having said that, I think this is the material. Next, yep, there's our fancy pictures again. We would, and I don't know if there's other questions, I'll just say, we offer a consultation if you want. If you have questions, let us know. We're here to assist. The Alliance has been great to us, and you guys do such good work. But feel free, we would love to help you if we can. If nothing else, we'd be glad to have a conversation. So feel free to reach out.
Thanks, Brendan. Are there any other questions in the last couple minutes that we have here? Did we get to all the questions in the chat? I think we did. Anybody, I'd welcome you to use the chat box or come off of mute to ask your question yourself.
I will say, my funny story is Tom Wood teases me about this headset, which does look a little unique on me. My kid is a pilot. My kid became a commercial pilot. So I tell people I'm just trying to be a pilot. That's why I'm wearing this thing. But the real reason is my microphone doesn't work so well on my computer. So.
All right. Will this credit become income to cost settle?
That's a good question. Yes. This credit, unlike the PPP income, it's considered income. So it's income it's potentially income maybe for UBIT. You'd have to look at that. It's technically income, although you generally don't pay tax. But on the cost settle, I think you got to look at the program itself to see if that would become an issue.
And then
I think
Suzanne
this last one's a good one.
Suzanne's got her hand up too, so
Oh.
make sure that we get to her.
Okay.
Suzanne, do you want to go ahead?
Sure. So if we go through all of this and say, I think I'm pretty comfortable that I qualify, I'm going to go for it. What's the penalty if you kind of screwed it up and you went under some assumptions that the IRS says, no.
Oh no, you should never have. Yeah. So again, I don't I think I know the answer, but there is no answer because I haven't seen any of that yet, because I don't know that they've dealt with that yet, because this is so relatively new. However, what in my practice, what the IRS will do is they would let's say they will either catch it when you file it and read the filing and say, no, you don't qualify, and throw it out the door. Excuse me, then no harm, no foul. If the IRS gives you the money and then a year or two later says, no, give us the money back, they generally would charge you interest on that because you had their money, and they would charge a penalty if they felt it was egregious or something like that. I don't know what egregious is in this case because this is so new. And a lot of times you can argue out of that penalty with the IRS and, hey, I'm a nonprofit and we didn't know, and this is a new credit. And so I would be shocked if the IRS did assess a penalty, but in that case, you would have to give the money back, and they would charge you some interest on it too.
Brendan, this is Angela Westwood from Continuum. I think
Okay.
I saw something from the IRS indicating that for this credit, they would not penalize folks if they relied on, because it is so confusing.
Yes, and I think that was relating to the fourth quarter change, because folks, but I could be wrong. I think it was related to when they eliminated the credit for the fourth quarter, and folks, there was a program where you could kind of you could get the credit ahead of time. And so there's some nuances there. So I think they said they wouldn't penalize that. And they've said, because even their website, frankly, it may be updated now, but for a while, their own website, the IRS website, was not up to date with the law changes. So I know they said, hey, if you rely on our website and which was wrong, and it's wrong, we won't penalize you. But they're generally good about that. As long as you say, hey, I relied on you, or it wasn't clear, or this is the approach we took, they're generally good about either not assessing, or if they do assess a penalty, of removing that. So, but thank you, Angela. That's a good point.
All right.
I think.
Go ahead, Tom. I was just going
I
to.
just want to take that. I think maybe one final, whether or not this is a complicated process to go through. I think, Brendan, correct me if I'm wrong. If it's obvious that you've got significant decreases in your revenue, it's just amending the 941s. But if you're working on the partial or full shutdown, the disruption, there's a lot more nuance, especially if you throw in state or federal funding, PPP. So you really would want to get, in that instance, someone to look, just to make sure you're not leaving money on the table.
Right. If you do the math is just incredible as to the benefit that's out there, that potentially is out there. If nothing else, talk to your accountant and press them. If they're not comfortable with it, press them. Because there's confusion in the accounting community too, more so than I want to admit. I'm a CPA, but there's a lot of confusion out there. So just and
again, feel free to reach out. You've got our contact information. If you'd like us to take a look, we can help you through this as well.
Yeah, and I'm going to send you all their contact information as well, so no worries about trying to scribble it down. But I think we have one final question from Alan about how can the state take back in cost settlement if the federal government is giving credit? And then does the cost settlement amount to subsidy to the state?
good questions, Alan. I don't know those answers.
I agree with them also.
Yeah.
I think this is another fight that the Alliance is going to have, as they did with the PPP loans.
Yep, that's a good point.
And I think the law is pretty clear that it's only federal double dipping.
I would agree with you, Angela. Yep.
Good.
I would encourage you to bring that to our next public policy committee meeting, or email Ben or Jeff.
I'll be in touch with Ben. I'll contact him.
Perfect. All right. Well, thank you,
great.
Tom. Thank you, Brendan. This has been really, really fantastic. I will send you all the recording. I'll send you the PowerPoint slides. I'll send you their contact information. So if you do have any questions or you'd like to take advantage of their 30-minute consultation offer, you'll be able to get in touch with them directly. I want to thank you all for being here and for, as always, being engaged and asking questions. You guys are the best. So with that, I'll wrap this session up. And if you have any other questions, please just shoot me an email.
Thank you.
Thank you.